Good evening, everyone, and welcome. I am Divya Gopalakrishnan, and on behalf of CareEdge, I welcome you to our today's discussion on Credit Quality Assessment H2FY24. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Ashwini Kumar Tewari, Managing Director, State Bank of India. Mr. Maninder Singh Juneja, Partner, True North. And Mr. Vineet Mittal, Chairman, Avaada Group. This session will be moderated by Mr. Sachin Gupta, Executive Director and Chief Rating Officer at CareEdge Ratings. We will commence this session with a presentation by Ms. Smita Rajpurkar, Director, CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in their panel. We will take up your queries during our panel discussion session. Now, may I invite Ms. Smita to make her presentation, please?
Thanks, Divya. Good afternoon, everyone. We welcome you to CareEdge Ratings webinar on credit quality assessment for the half year ended March 2024. On behalf of the entire team at CareEdge Ratings, I would like to thank Honorable Minister of Road Transport and Highways of India, Shri Nitin Gadkari ji, to have shared his thoughts on our credit quality assessment. In today's presentation, we will be covering an analysis of the credit quality of CareEdge Ratings rated portfolio in H2FY24 in the backdrop of the global and domestic economic landscape. The domestic economy has been standing strong against the challenges from the global economic scenario. In this setting, it would be interesting to see how CareEdge Ratings portfolio has performed. Let us begin with the highlights of today's presentation. CareEdge Ratings credit ratio, that is, the ratio of upgrades to downgrades, surged to 1.92 in the second half of fiscal year 2024, up from 1.67 recorded in the previous half year. If we map this with a long-term average credit ratio of 1.57, we can see that the credit ratio at 1.92 is way above its 10-year average credit ratio, which is indeed comforting. If we look at the sectoral cuts, we can see that the credit ratio for the manufacturing and services sector picked up to 1.80 from 1.38 in the previous half year. This is largely contributed by healthy consumer spending in hospitality, realty, auto dealerships, and jewelry retailers, and consequent upgrades in these sectors. Infrastructure sector's credit ratios stayed robust at 2.29 in H2FY24, slightly higher than 2.21 in H1FY24, driven by upgrades in the transport infrastructure and power segments. Infrastructure has been the most buoyant sector in this half year, and the credit ratio for the sector has consistently remained above 2 times post the pandemic disruption, as endorsed by our Honorable Gadkari ji. Credit ratio for the BFSI entities tempered from 4.20 in H1FY24 to 1.94 in H2FY24, mainly attributed to higher downgrades in the NBFCs. The credit quality of the overall portfolio thus looks upbeat. Let us now have a look at the economic landscape. To start with, let's look at how the global economy has been performing. The global economy is projected to grow by 3.1% in 2024, same as that recorded in the previous year. The growth remains weak compared to the historical average of 3.8% amid high interest rates, withdrawal of fiscal support, and high debt levels. The US economy, though, is estimated to have grown by 2.5% in 2023, showing greater than expected resilience. China's economic growth is projected to slow down from an estimated 5.2% in 2023 to 4.6% in 2024 in the absence of any large-scale stimulus. A slowdown and consequent demand pressure in China elevates the risk of China exporting to India as well as other countries at competitive prices, which may hit the Indian manufacturers adversely. Global headline inflation is projected to moderate from an estimated 6.8% in 2023 to 5.8% in 2024 and further to 4.4% in 2025. However, recent data suggests that the downward trend in inflation may not be as smooth as previously expected. Going ahead, the geopolitical risks, prolonged global slowdown, and risk of China flooding the global markets with inexpensive products remain key monitorables on the credit side. Let us now see how the Indian economy has performed in this backdrop. Domestic economy to state the course. Indian economy grew by 7.6% in FY24 as per the second advanced estimates. supported by strong investment demand, mainly due to government's capex push. We project the GDP growth to be at 7% in FY24. The quarterly GDP growth numbers depict strong growth at over 8% YOY in the first 3 quarters of the fiscal, which is indeed very encouraging. In terms of consumption, rural demand remains weak, facing headwinds from agricultural uncertainties and elevated prices of essential food items. Gross fixed capital formation also showed a strong YOY growth in this fiscal, rising by 10.6% in Q3 FY24, supported by strong government capex. Though growth in private consumption expenditure remained weak compared to pre-pandemic average of approximately 7%, it recovered to 3.5% in Q3 FY24 from 2.4% in the previous quarter. Retail inflation held steady at 5.1% in February, remaining within the RBI's upper target of 6% for the sixth consecutive month. Core inflation continued to trend lower, consistently staying below the 4% mark in the last 3 months. We project retail inflation to moderate to 4.8% in FY25 from the estimated 5.4% in FY24. On the policy front, RBI is likely to maintain status quo on both rates and stance in its upcoming policy meeting. We expect the RBI to opt for a shallow rate cut cycle of 50 bips starting Q3 FY25. High-frequency economic indicators such as GST collections and e-way bills depicted in the left chart and PMIs in the right chart continue to signal healthy economic activity. GST collections clocked the second highest ever monthly collection at 1.78 lakh crore in March 2024. PMIs shown in the right chart have also remained in their expansionary zone of above 50. The left chart shows the trend in bank credit growth picking up steeply post the pandemic. The chart on the right shows that credit growth continued to be led by the personal loans and services segment. However, moderation was seen in the credit growth to NBFC at 14.7% as of February 2024 versus 31.9% in February 23, and in the personal loans at 18% versus 20% in February 2023 due to the rise in banks' risk weights for both these segments. Outlook for bank credit offtake remains positive amid a rise in capex, growth in retail credit, and the anticipated expansion in private investment. In FY24, credit offtake is anticipated to close with a growth of around 16%, excluding the HDFC merger. We estimate credit growth to be in the range of 14 to 14.5% at the end of FY25. With this in the backdrop, if we look at the external front, services exports are holding up well, while merchandise exports have been under pressure. But we have seen green shoots with the recent numbers on exports being encouraging. Merchandise exports are likely to show some improvement in FY25, aided by better prospects for global trade. Upbeat performance in services exports is expected to continue, albeit with some moderation. The chart on the right shows net FDI inflows, which have also moderated to USD 15.4 billion in 10 months FY24 from USD 25 billion in 10 months FY23 amidst continued global slowdown. Nevertheless, we can see a silver line in the net FPI inflows during FY24, wherein net FPI inflows in debt surged to USD 14.6 billion in FY24 compared to net outflows of USD 1 billion in FY23, supported by India's inclusion in the global bond indices. Going ahead, a broad-based recovery in the domestic consumption scenario and a meaningful pickup in private capex, along with weather-related uncertainties, would be the critical watchouts. We can thus say that while the global uncertainties still linger, Indian economy has managed to stay strong. Let us now deep dive into analysis of the performance of CareEdge Ratings portfolio in H2FY24. In this chart, we have shown the dispersion of our rated portfolio over the last 5 years. We can see that till FY20, the highest number of ratings were in the BB category. In FY21, the median rating moved to BBB rating category with an increase in the proportion of investment grade ratings in the active portfolio. The median rating continues to be at BBB category since then. We'll now move to our credit quality assessment for the half year ended March 2024. In this chart, we can see how CareEdge Ratings credit ratio, that is, the ratio of upgrades to downgrades in the portfolio reviewed during the particular half year, has performed over the past 10 years. The credit ratio had been around its long-term average till the onset of the pandemic, when we saw the highest number of downgrades. Post the pandemic, the credit ratio saw an uptrend till it reached its peak at 3.74 in H1 FY23. The credit ratio then moderated in the next 2.5 years. H2 FY24 again saw an uptick with the ratio of upgrades to downgrades moving to 1.92, wherein CareEdge Ratings reported 357 upgrades and 186 downgrades. The ratio in H2 at 1.92 is comfortably above the long-term average of our credit ratio for the last 10 years, which is around 1.57. Let us now look at the performance of the credit ratio across portfolio cuts. This chart shows us the trends in the credit ratio of our investment grade, that is IG, and below investment grade, that is BIG, or sub-investment grade entities. The investment grade entities are entities enjoying ratings of CARE BBB- and above. The past 5.5 years have seen a trend of higher proportion of upgrades in the investment grade entities, but this half year saw broad basing of the credit quality with a credit ratio of both investment grade and sub-investment grade entities at par. This can be attributed to higher upgrades in the sub-investment grade portfolio, largely in sectors like agri-based products, real estate, hospitality, and auto dealerships. With a credit ratio of close to 2 for both investment grade and sub-investment grade entities, we can say that the upswing in the credit ratio this half year has indeed been broad-based. The same trend can be seen in this chart as well, where we have shown proportion of upgrades and downgrades across our various rating categories. So here we can see that upgrades have far outnumbered downgrades across our rating categories. If we see the BBB rating category, which is our median rating, as we had discussed earlier in our presentation, we saw 14% of the portfolio reviewed being upgraded, while 9% of the BBB category ratings reviewed in the half year were downgraded, and the balance 77% of the BBB ratings were reaffirmed with no change in their ratings. So the broad basing of the credit quality is clearly visible. This slide shows us the percentage of upgrades and downgrades to the total rating actions over the years. In this chart, we can see that the upswing in the credit ratio in H2 FY24 is primarily driven by lower proportion of downgrades in the rated portfolio in this period, down from 9% in H1 FY24 to 7% in H2 FY24. Overall, the portfolio has remained stable with 80% of the ratings being reaffirmed. From the past few slides, we can see that the CareEdge Ratings portfolio has seen an uptick in this half year, with the credit ratio edging up to 1.92 from 1.67 in the previous half, with a broad basing in the credit quality. One of the reasons to which we can attribute this uptick could be deleveraging of the balance sheets. We did a study on the deleveraging trend across top 1,000 listed companies. So here we can see clearly that there is a noticeable improvement in the leverage profile of these top 1,000 listed companies, with the average overall gearing steadily moving down from 1.02 in March 2014 to 0.53 in March 2023. Now let's move on to the sectoral trends in the credit ratio. As we can see in the slide, the credit ratio for the manufacturing and services sector depicted by the gray trend line has seen the largest upward delta, moving up from 1.38 in H1 FY24 to 1.80 in H2 FY24. Infrastructure sector has continued to remain buoyant post-COVID, with a ratio of over 2 times for the last 3 years and inching up from 2.21 in the last half year to 2.29 in H2 FY24, as depicted by the navy blue trend line. Credit ratio of the BFSI sector, which is the teal trend line, has tempered from 4.20 to 1.94 in H2 FY24. The strength in the manufacturing and services entities was mainly driven by higher proportion of upgrades in hospitality, realty, auto components and auto dealers, iron and steel, and pharmaceuticals. The credit ratio of infrastructure sector in H2 FY24 rided on higher number of upgrades in the transport infra segment, followed by power segment. Credit ratio of the BFSI sector saw a downward momentum, majorly driven by higher number of downgrades in the NBFCs. Notably, a significant portion of these downgrades stemmed from few large groups. Banks did remain strong. Let's now understand the reasons for upgrades in these individual sectors, our outlook, and some key monitorables on the credit side. Starting with the manufacturing services sector, large proportion of our rated entities would fall in this sector, where we saw an uptick in the credit ratio to 1.80 in this half year. In this slide, we can see two charts. The left-hand side chart shows us the trend of the credit ratio, and the right-hand side chart shows us the proportion of upgrades and downgrades in the entities reviewed by us in the last 3 half years. In the right chart, we can see that 12% of the entities in the manufacturing services sector were upgraded in H1, in H2, vis-a-vis 7% being downgraded. Key sectors driving upgrades were hospitality, auto dealerships, realty, and jewelry retailers, which is reflective of healthy consumer spending in India in these sectors. Auto component manufacturers, iron and steel, healthcare, and transport services also continue to do well. Downgrades were primarily observed in chemicals, textiles, and cut and polished diamond sectors, primarily due to slowdown in export demand and Chinese competition. Subdued global demand continued to impact export-focused entities during H2FY24 as well. If we look at the industry-wise trends in rating actions, we see that hospitality sector has done exceedingly well, followed by auto components, healthcare, iron and steel, and real estate. Our overall outlook on manufacturing companies remains stable. Sustained domestic demand and government spending on infrastructure are reassuring. Service sector entities focused on domestic consumer demand will continue to benefit. However, subdued global demand may impact some export-focused sectors, albeit timely fructification of the free trade agreements with key nations can provide some cushion. China's slowdown can make certain sectors vulnerable to competition from it due to the aggressive exports in global markets, including India. Let us now move on to the infra sector. The credit ratio for infrastructure has inched up to 2.21 in H2FY24 from 2.21 in H1FY24, with 17% of the portfolio witnessing upgrades in this half year. Key identifiable drivers for upgrades were commissioning of projects, especially in the road HAM segment and solar power generation space, realization of past overdues due to implementation of equated monthly installment scheme and consequent deleveraging initiatives in thermal power as well, refinancing of projects at better financing terms and structured financing avenues like co-obligor arrangements, InvITs, etc., enhanced execution pace along with stronger order inflows in construction and transport infra entities, operational HAM assets, and launch of InvITs, enhancing financial flexibility of large EPC developers. Downgrades were driven by sluggish execution pace and high working capital intensity, putting pressure on the credit profile of moderate EPC players, and non-renewal of short-term PPAs with CNI customers at a remunerative tariff. Transport infra and power segments drive infra upgrades. The chart shows the proportion of upgrades and downgrades over 4 half years in the transport infra, power, and construction verticals. We can see that the transport infrastructure segment saw significant high number of upgrades in H1FY24 at 25% compared to downgrades at 4%, followed by power sector with 17% upgrades, while construction saw slightly higher downgrades in this half year. Our outlook for the infrastructure sector also remains stable. In the transport infra vertical, we expect enhanced revenue visibility with infrastructure push by the government across segments, that is airports, seaports, highways, and urban infrastructure. Toll collections are likely to grow by 12% in FY24, supported by favorable movement in WPI and traffic revival. Coming to the power vertical, thermal PLFs are likely to remain steady at above 65%. Implementation of the EMI scheme to continue to be the key enabler for improvement in collection efficiency and deleveraging. Renewables tariff is expected to rise but shall remain competitive vis-a-vis conventional power. Persistent headwinds could be with respect to execution-related challenges, regulatory uncertainties in key states, increase in input prices, and interest rates. Overall, our outlook for infrastructure remains stable. Moving on to the banking and financial services sector. Banks and financial services sector reported credit ratio of well above unity for the past 2 years, with the trend continuing in H2FY24. The ratio crossed unity for the first time in H1FY22 after a period of 2 years post-COVID. Subsequently, with the sector continuing improvement, the credit ratio peaked at 4.2 in H1FY24. The dip that we see in the credit ratio during H2FY24 was driven by downgrades in the NBFCs. NBFCs have seen higher upgrades than downgrades in the past 2 years. However, in H2, the number of downgrades in NBFCs increased significantly. The downgrades can be attributed to multiple entities under a few NBFC groups and few fintech NBFCs, which saw continued moderation in the credit profile due to existing asset quality issues and impact of regulations on these business models. The sector faced regulatory challenges with RBI increasing the risk weights on unsecured personal loans and loans provided to NBFCs in November 2023. RBI's concerns stemmed from the continuous growth in the scale of NBFCs, especially in the retail and unsecured personal loan space. But the balance sheet strength of the BFSI entities has acted in their favor to avert major downgrades in the sector. Upgrades in the NBFCs were triggered by growth in the AUMs and resulted improvement in profitability, higher returns, healthy asset quality, and improved capitalization. Most of the entities in the sector have exhibited strong performance. Despite rising interest rates, profitability in mid-sized NBFCs, financial services will be protected, with business growth leading to optimization of operating expenditure, moderated increase in interest rates, and controlled credit costs. Banks did not see even a single downgrade in the past 2 years. Upgrades were mainly on account of improvement in asset quality, capitalization, and profitability. Our outlook for the BFSI sector remains stable. Credit growth in the banking sector has remained strong in FY24 at around 16.5% ex the HDFC merger. The net non-performing assets ratio for the banking sector is at its lowest ever levels at 0.7% as at the end of Q3 FY24, due to continued improvement in the asset quality and high provisioning coverage maintained by banks. In this backdrop, the credit outlook is expected to be stable for banks and financial services entities. With this, we come to the end of our presentation, and we will sum up our observations. Credit ratio of the CareEdge Ratings portfolio saw an uptick in H2FY24, with Indian corporates holding steady ground and amid the lingering global challenges. We project India's GDP growth to be at 7% in FY25. Corporate India is stable, anchored by healthy domestic demand, deleveraged balance sheets, and government's infrastructure focus. In this backdrop, the credit ratio in the near term is expected to remain stable. Going ahead, the geopolitical risks, prolonged global slowdown, risk of China flooding global markets with inexpensive products, and weather-related uncertainties remain key monitorables on the credit risk. To conclude, corporate India has indeed remained strong amid global uncertainties lingering. In the presentation today, we have broadly highlighted the key credit drivers and our sectoral outlooks. For a more detailed coverage on each of the subsectors, please refer to our full report, which will be released on our website after the webinar. That is it from our side. Thank you so much. We will now hear from our eminent guest speakers and understand their views on how they see the performance of various sectors. Handing over to Divya.
Thank you, Smita, for your presentation. As conveyed earlier, all attendees are requested to key in their questions, which we will take up post our panel discussion session. Now, may I invite Mr. Sachin Gupta to take over the session, please? Mr. Sachin Gupta is the Executive Director and Chief Rating Officer at CareEdge Ratings and has over 23 years of experience in leadership positions across the credit rating business. Prior to joining CareEdge, he has worked as a Senior Director at CRISIL and managed the corporate and infrastructure ratings. Over to you, Mr. Sachin.
Thanks, Divya. I just wanted to check if Mr. Ashwini Tewari has also joined. Mr. Tewari, can you hear us? Okay. Anyways, in the interim, let me just do a quick introduction of our panel. I am really thankful for all our panelists to be able to spare time out and join us in this session. We have with us Mr. Maninder Singh Juneja, partner True North. He joined True North in 2016 and is involved in managing businesses in the financial services sector with a total experience of over 3 decades, most of it in retail sector, retail financing. He has set up and exponentially grown businesses in retail assets and deposit franchise in his role of retail business head at ICICI Bank. He's also overseen the evolution of retail financial services in India as a board member of CIBIL, NPCI, IARC, and ICICI Home Finance Limited. Maninder, in his current role, works with entrepreneurs and the management teams of partner companies, mostly BFSI entities, to scale them to their full potential. He has done his bachelor's degree in civil engineering from MS University and his post graduation from IIM Lucknow. He's a fitness enthusiast and likes to watch movies. Hello, Mr. Maninder. A very warm welcome to our event.
Sachin, I was not able to log in, so I was here. Could hear
No
you.
problem, sir. No problem. Very nice to see you. Let's take your introduction next. Shri Ashwini Kumar Tewari, he is the Managing Director of Corporate Banking and Subsidiaries at State Bank of India. He started his career in SBI as a probationary officer and has spent more than 3 decades with the bank in India and abroad. Currently, he's handling the portfolio of large corporates and commercial credit business of the bank, along with associates and subsidiaries of the banks. Prior to this assignment, he was managing director of risk, compliance, and stressed assets. And he's also served as a managing director and CEO of SBI Cards and Payment Services Limited. He's an electrical engineer by degree and a certified associate of Indian Institute of Bankers. He's also a certified financial planner and has done a certificate course in management from Accelerate. A very warm welcome, sir. Then we have with us Mr. Vineet Mittal. He is the chairperson of the Avaada Group. He's a distinguished alumnus of Harvard Business School and is a serial entrepreneur known for his remarkable success in the fields of IT services and green energy. He founded Wellspun Energy in 2010, which swiftly became a leading player in India's renewable energy sector with an impressive 1.2 gigawatt of installed capacity. And thereafter, he successfully monetized the company to Tata Power in 2016 with a valuation of $1.4 billion. Mr. Mittal launched Avaada Energy in 2017, and the group's operations now encompass renewable power generation, solar module manufacturing, green hydrogen, green ammonia production, and electrolyzer manufacturing. Avaada Energy is the fastest growing renewable energy IPP in India, and it targets to reach 11 gigawatt of capacity by 2026. He holds key positions such as co-chair of the B20 Task Force on Energy, Climate Change and Resource Efficiency. He's also the chairman of the CII Subcommittee on Hydrogen Usage and Standards. He's the chair of the CII National Council on Climate Change and the chair of Make in India Task Force. His notable recognitions include the prestigious Solar Man of the Year award. So great, very indeed a very illustrious panel we have, and I have the difficult job of really getting most out of all these illustrious people. Let me start with Mr. Tewari. Sir, one of the key things which we saw in our presentation was the high credit growth that we have seen in the last few years. But one of the key things that we noticed there is that most of this credit growth has been either on the retail side or on the NBFC's lending. And now that RBI has kind of in some ways given a nudge of not really going unbridled credit growth in some of the segments of NBFCs, how do you see the credit growth will evolve, in the next 2 to 3 years?
So you're right in the initial comment that the post-COVID, the credit growth was largely driven by the retail side. And within the retail, it was gold loans, unsecured, and these were the major drivers. But subsequently, the last 2 years, the real estate housing loans have also picked up. They are quite strong now. So all shades of retail loans are doing well. There is some impact of the RBI's risk weight guidelines, but it's not very strong, especially on the bank side, on the retail loans part. Of course, on the NBFC lending, what has happened is that we have become more cautious and we have pricing better. That's necessary in view of the risk weights. What we have seen the last 1.5 years at least is the fact that the corporate side has picked up well. For previously 2-3 years back, we were always saying that the plans are there, the discussions are happening, but proposals were not materializing. But last 1.5 years, actually, the corporate side has really picked up. And this year, we just closed the year. We can't disclose numbers, but the percentage terms of corporate growth is actually higher than the retail side for the first time in the last 4-5 years. So which means the actual those plans have fructified, the sanctions have been done, and now these are the disbursements which are converting to a loan growth. So I think the corporate side, MSME, everything is driving well. I mean, we have seen good growth in all across. So therefore, to me, the next few years will be driven by both corporate side investments, loans, and also the MSME, which is in some senses draws from the corporate sector, because most of them are either suppliers or vendors of the corporate side, corporates, and the agri as well. And agri, we are seeing a lot of investment credit happening, not only the traditional Kisan credit card, which one could argue were not really working capital, but also involved a lot of personal utilization. So that part again, it's a good thing. The FPOs and the self-help groups, these are good segments. We are seeing a lot of growth, and these are segments which have very few defaults as well. So they're good credit as well. So that's how I see it panning out in the next few years.
Got it. Just a follow-up question, while agri is fine, but, and you did mention that the corporate sector, it's kind of very interesting because when we looked at RBI data, the credit growth in the industries, as they call it, is ballpark about 8-9%, whereas the services and the retail is still, in higher teens or so. So can you share with us, maybe, SBI has a different this thing, maybe more corporate exposures are being done there. But can you indicate some sectors specifically which kind of are, really helping the book grow?
So the sectors which come to mind, one is the infra has been strong. So roads have been doing well for some time now.
Right.
Of course, the latest thing is more of conversion to InvITs, etc.
Right.
And fresh roads coming up. But clearly that has been a growth area, and renewables has been a consistent growth area for the last 2-3 years. A lot of action happening in all across solar, wind, everything. We are also seeing a lot of capacity enhancements in major things like steel, cement, and not all of them are borrowing, but there is a lot of this thing happening. Even in thermal, we are seeing some growth happening, especially from the state-owned players, some of which are investing there. And last 5 years, actually, thermal had not grown much at all. It was largely the NTPC, etc. But now
Very true.
coming in. So I think the power, road, cement, steel, renewables, those are the 5 big sectors. And of course,
Right.
in between, there are niche sectors like, let's say, pipes and all. Many of them are derivatives of steel, etc. So construction is the other sector. Last 1 year, we've seen a lot of growth there as well. A lot of companies taking finance not only for the construction side, but also the lease rental discounting in terms of monetizing whatever has been leased out, etc. All of that is also showing very strong growth. So for us, the corporate growth has been really good this year.
Great. Thanks a lot, sir. I think it's you've really given a good flavor, and what is heartening to know is that all the sectors that you mentioned, most of them are largely the core sectors, infra, steel, cement, etc., which will then have some kind of a domino effect as well, as the downstream industries kind of then get connected. Let me get Maninder now, and this is on the NBFC. You look after many of these NBFCs as the part owner. We have seen, NBFC, we really have to unravel, because when I look at the pure numbers, numbers in 23 and 24, they both the years looked at pretty much strong growth on the asset book, along with reasonably low credit cost, right? So the asset quality is good and the growth is good. And on top of that, there is equity infusion also in some of the, private equity kind of invested companies. Now, but then we see RBI's actions, right? In which kind of it means to us that there is some concern that RBI has. Obviously, there are multiple segments in NBFCs, and yes, the concern could be in one or the other. But how are you seeing, from a credit side, from the risk side, how are NBFCs going to look in the next 2 to 3 years? Are we seeing, because NBFCs have been prone to sudden jerks, that is not yet visible in numbers, because as a rating agency, we look at these companies on at least a quarterly basis. We're not seeing that stress. So how do you, as a, from your perch, Maninder, how do you see this panning out in the next 2 to 3 years?
Thank you, Sachin, for the question. See, I have been seeing this industry for a long time, and I have not seen the quality of book and the strength of the Indian consumer, what we are seeing in the present day. I was looking at some of your reports earlier. The entire migration of scores, bureau scores to higher scores, about 8 to 10% of people who are between less than 725 odd score have moved up. So where is the strength of NBFC quality coming from? It is coming from fundamentals. One, your average GDP is growing. The number of people who are getting jobs are higher. they are paying on time. All that is what is the outcome is, what we are seeing is in the NBFC performance. And the growth itself in retail has been so high over the last few years that banks are getting better quality at a better, at the prices which they can afford. And there is space for NBFCs to grow, to go to tier 2, tier 3, tier 4 markets and lend there. So combination of the average, GDP or average wealth of a family leading to and on that side also there are two different segments. See, the other part you said is when the variations coming, performance get jerks and what you mentioned. That is more what I have seen over, and I've been in this industry for the last now 30 years, as you mentioned, more than that. So the quality goes down once in a few years, and that has been the hit by unsecured. Secured ones have been rare, and whatever has been lost has also been gained. It is not that you lose your shirt on it. Where the NBFCs are most vulnerable, and we have seen in MFI and we have seen in some of our portfolio companies what happened during COVID and the recovery period after. It is the unsecured. The unsecured, is the one which gets the heat. But the difference between past and now is even these the new fintechs and other people who are coming in, they are taking in far more data which is now available than was available, but which was not available earlier. Two, the people who are coming in have got multiple job opportunities. There was no gig workers at a point of time. Now people who are going off to job, and I have met a large number of them, they go and work with somebody else. They are able to generate on a daily basis a decent amount of income. I was in a very small town, in South India, where a husband and wife labor team, they both were laborers, they were getting 1,400 rupees a day, and they were getting 25 days of work. So they can now afford what they are doing is they are going and asking the NBFCs to, live a more comfortable lifestyle by looking at a house or taking a loan or building some infrastructure in their own house. And they are preponing that, and they're working hard to pay it. So there is very strong fundamental growth in India, which is bringing this about. And the money is flowing not only in towns, but into smaller towns and villages, which is not.
Yeah. Got it. I think 2 or 3 big messages that I'm getting, Maninder. One is that it's a widespread thing, the overall, what we call as the demographic dividend, etc. So the jobs, the GDP, and also I think the credit discipline because of these bureau scores, etc. So people know the cost of default. So all that is aiding in the improvement. But I think the other point that you're making is that the way I read it is that for the unsecured loans, we should be a bit careful. So in that sense, you are echoing what even RBI is saying. Maybe the growth is very unbridled. So while secured, the asset qualities may not really get impacted, but on the unsecured side, we should it merits to look at carefully. And if some entities etc. are growing very fast, they should look at it more carefully. Is how I'm reading a message. Yeah. Great. Mr. Mittal, the one thing that and I've been a infrastructure analyst, almost all my life. One of the things that I'm seeing is that the factors which Smita also mentioned is this whole EMI scheme that has happened, for the state discoms, and because of which we are seeing significant improvement in renewable gencos, thermal gencos, in terms of their debt coming down, their debtors coming down, and all that. Now, the concern that we have is that this kind of thing always happens. Every 5 years there is some scheme that comes, and then again we go back to the same thing of increasing receivables, etc. So the question that I have is this sustainable? Is this sustainable in terms of the long run, that the high debtors that traditionally all IPPs and Gencos have had, the current structure that is working out, do you think that will kind of run for a longer time and therefore improve the credit quality or keep the credit quality strong?
A very good question. The implementation of EMI scheme, if you look at for state discom, it has been a significant turning point, particularly with a weaker discom initiating the clearance of their past dues to generating companies. So this is along with LPS and not allowing state discom who have an outstanding payment to purchase the power from exchange. So what government is doing is actually multiple things. The first thing they are focusing on is honoring the contract. by bringing these disciplines and processes. And in addition to that, earlier what they used to do is dole out 2 lakh crore scheme or 1 lakh crore scheme, restructure the loan, etc., and not go into the comprehensive reform. So, say for example, when they started studying and saw that 30% plus power goes to the farming sector, and that they are supplying during the night shift, and that is coming through the coal, and coal's LCOE for the new projects are above 5.5 to 6 rupees. They came out with the Kusum C program, where they encouraged every state to segregate their farmer network versus regular network. And now many states like Uttar Pradesh, Karnataka, Rajasthan, and exceptionally well in Maharashtra. Like for example, Maharashtra recently bidded out 18 gigawatt, and their intent is, if you look it as a case study, they have hired McKinsey to transform their entire distribution company, transmission company, as well as their generating company, and bring them to the path so that by 2030 they list. And how they are doing it, their biggest challenge was the farmers load. They are moving all the farmer load. They segregated the entire farmer load through the different substation, getting solar bits out and supplying them power in the day shift. So farmer is more happy. They don't have to get up in the night to use the power and use their pumps, etc., and creating a separate payment security mechanism backed by the state, so that the discoms don't have the pressure of solving it. In addition to that, what they are doing is with this PM Grah Yojana of solar, they are actually all the their low unit subscriber, they are going to move them where there was a cross subsidy and etc., to the rooftop scheme. And even if they succeed 50%, though the subscription in the post office has crossed the 1 crore target already, but even if they succeed 50% implementation in next 4 years, you are going to see a lot of those pressure going away from discom, and they sourcing the cheaper power from those distributed generation. And thirdly, they with all these with RDSS, they are reducing their transmission losses significantly. And what we are also seeing, a lot of these litigation which these utilities used to have and not close for 10 years, 15 years, we have seen a growing trend of Supreme Court, regulatory bodies like APTEL, etc., taking strong decisions and ensuring that distribution company, etc., reduce their litigant mindset. So if we see the strength of collaboration like MS Maharashtra State with McKinsey, and then proactive measures, because they were getting 100 basis or 150 basis point expensive loan than their peer group, and bringing out a complete transformation roadmap, and then supported by state government, etc. I think if they implement it in totality, you will see a growing trend of Maharashtra model being followed in Rajasthan, Uttar Pradesh, and few other states. And once that gets executed, I think this behavior change which government is trying through the stringent policy, where you pay for what you buy for, uh, I think it will see a permanent remedy in long term. And that's
Great,
what
great.
I'm
Yeah.
looking for.
I think you're right. I think we are also seeing, very clearly TNT losses, which has always been the bane of the sector, coming down quite secularly across most of the discoms, and also things like smart metering, etc. So I think finally the technology will really allow us to really have
And
significant
prepaid meter, time of
prepaid
day
meters.
metering,
Correct, correct,
all behavior changes. And
correct.
on top of that, your APPC is coming down with 50% renewable energy, even at
Right.
350 average. And it's not LCOE of 6 rupees, which actually someday will become $8. This is like
Right.
25-year static single pricing, which means
Right.
if you look at the levelized cost of electricity, it's less than 2 rupees.
Correct,
So,
correct.
so with that
So
cost of
yeah, so
electricity,
great, great, great. Thanks, Vineet. Sorry, I'll just get the next question in with Mr. Ashwini. Sir, the banks seem to be in a reasonably sweet spot, maybe the best spot ever on in terms of the NPAs. PSU banks had this whole challenge of very high NPAs, and then there was both, I think, the equity that was infused by the government, and then they kind of set their house in order in terms of their credit appraisal, this thing, and then also changes in how they really appraise. And now we are seeing lowest ever NPAs. Now, how do you see it? And I'm not saying really immediately. Obviously, these things take time. But if we were to take a 3 to 4 years or maybe 2 to 3 years, do you see some sectors where there could be some slippages and therefore you are more careful taking exposures to those sectors?
So actually, in any business segment like this, banking, of course, is a reflection of all the industry segments we deal in.
Right.
Therefore, credit cycles will happen. I mean, this is something which is every 5-10 years there will be a cycle. It can be a sectoral cycle. It can be even an industry cross industry cycle as well. So therefore, the learnings from the previous cycle have been really taken by the banks. And since the previous cycle was largely driven by infra, whether it's power, roads, etc., all of those. So there we have become very careful. So, for example, today we do not disburse anything unless the 90% of the land is acquired.
To the HAM projects, yeah.
Not only HAM, but we are even talking about metros and so.
Okay.
Similar, even pump storage, hydro, etc. All of them, whatever requires land and a clear right of way. So unless that is in place, we don't disburse anything, even if we have sanctioned. Similarly, all clearances have to be in place, and also we have become much more careful in underwriting. We do not hope for any clearances to come, even if it's a reputed group, etc. Those are some things. We are putting in a lot of BSRAs, 3 months, etc., which it's made regular. It's like become a hygiene factor. So these are things which earlier we were sometimes waiving, not doing, etc., no longer. So one is the underwriting and how we look at these things is something we have improved. Now the worry part, as you talk about, what do we worry about actually? What can go wrong actually? Sectorally, we can talk about various sectors, but I think the major thing is one is the follow-up of credit in the banking space still needs some upgrade. So one, of course, is that in the retail side, it's a completely different way to do things. But there, the increasing digitalization of the credit is a factor which most of the public sector banks have to solve for, which is that how do you recover, collect digitally? How do you collect through call center and then go on to feet on street, because feet on street is very costly. And then most banks so far had depended on largely their own staff. The outsourcing part was more strong in NBFCs rather than in public sector banks. So therefore, every bank is now looking to build dedicated collection verticals, not the hard recovery ones, which is already in place. But these are ones where in the retail side, largely we have to build that. That is one aspect. And second aspect, as far as infra and other larger industry goes, that a lot of banks are depending on the ASM mechanism and the LIE models, etc., to see whether projects are on track, whether things are working as they should. But my view is that, again, these are things we have to be much more granular. We have to we cannot totally outsource everything. We have to have some sense of how things are going, because right now things are good, but then unless we monitor well, there could always be a challenge going forward. And on the NBFC side, though, Maninder ji has said, and I agree with your thing also, we haven't seen anything stress on the ground. But there are a couple of concerns. One concern which as a banker I have is that every NBFC seems to have 30-40 lenders. Now, for a similar sized loan on a manufacturing side or even on a service side, there will be just 3-4 banks max, maybe 5-6, not more, because handling large number of banks is always a challenge. So we have discussed this with a lot of NBFCs. Why do you want 50 banks and non-banks and God knows whatever else? Nobody has a clear answer. Everybody says flexibility, lower interest, and all that. And this is applicable across industries. So our sense is that while this may be flexible, but it also gives a lot of leeway for those who are not with the best corporate governance. They can switch around and their portfolios could be of different shades, which we are not able to monitor well. And many of them seek deviations even for a meeting of lenders. So I think those are not good practices at all. And we are pushing back against those and trying to work with other lenders that let us combine together and either bring them to a consortium kind of setup, or at least have mechanisms whereby we jointly monitor. I think there are platforms coming. Citi had done something, but nothing has scaled so far, which is where all the portfolio of the NBFCs is scrubbed against bureau data, scrubbed against various other data to dedupe it and also to see the health of the underlying data, so that the fear of evergreening is gone. I think that's a point which we have been sharing this with RBI. Now, our expectation was that there would be some kind of a policy change which would say that, okay, not more than so many banks, etc., some guidance. And that guidance may still come, but they have gone ahead and actually raised the risk weights, which is fine. But then that hurts everybody equally, the good quality ones as also those who are not actually following the rules. So that's one thing which I worry about on NBFC side, because this system interconnectedness is so strong. NBFCs are lending to customers. We are also lending to maybe the same customers. We are lending to NBFCs. So it's all linked up. We are buying portfolios, we're buying PTCs. It's all very interconnected. So anything going wrong with a couple of larger players will have a system-wide
I think very, very interesting points that you made, because as a rating agency, normally we don't look at it like that. Generally, we will see, okay, if there are more bankers, it's diversity. They do bonds also, they do securitization also. But you've given a different perspective. Maninder, you have some thoughts on this in terms of what Ashwini ji is saying?
I think, yeah, the whole evolution of the multiple lenders have happened because all the NBFCs and HFCs were very small at one point of time and have grown from there. Now, at that point of time, no banks or institutions were willing to give large limits. The only way everybody was wanting to reduce risk in banks, and I have been on the other side, for 2/3 of my life and 1/3 of the life on this side, where we never wanted to give, you wanted to be a small part of the whole portfolio. So you said diversification there was a seen in good light by a bank. Because there are multiple banks, and if you go to a public sector bank, if SBI is there, everybody else is comfortable. Or if ICICI or HDFC is there, then everybody else is comfortable. So it has been that way leading, and NBFCs came in first. In most of these, if you look at the order of the lenders, first it is the small NBFCs who are lending, then they go to the larger NBFCs, then they go to private sector banks, and then they go to public sector. So the whole consortium is already existing by the time a company becomes 400, 500 crores. And Mr. Ashwini, you can also comment, because I think the outcome is because of that reason, and it is not because people are wanting to go, and risk is one part, but it is just the evolution which has caused this to happen.
Take your point, but now having reached a certain level, I think now it's time for consolidation actually. We cannot continue to have 40, 50 banks. It's very, very onerous for everybody.
Yeah, that is true. So we can always look at the number of banks coming on. So what happens if you look at is the NBFCs keep on falling off. As the company rating improves, the NBFCs keep on falling off. One or two remains, but mostly it is the banks which come in. That's the So what would be in your mind? What would be the size of an NBFC, and what would a bank be comfortable to lead? Because I have also, this is the first time I'm hearing a different view. So I would also like to know, from the other side, what are your thoughts on this?
No, my sense is like this evolution part. I take your point on that, but my sense is that any NBFC which has reached a certain size, and there are banks willing to fund. I mean, I don't think, at least as far as we are concerned, we are willing to lend high. So why would somebody want to take only 50 crores from us? Why not 500 and take out 10 banks as a result, 10 banks or 10 other players as a result of that? Because we would like to have more closer monitoring. Because as I explained, the whole thing around interconnectedness, because we buy the same portfolio, the recovery or the follow-up continues with the NBFC. We buy the pass-through certificates as well. We buy so many. So it's like there is a lot more engagement than actually the parent on a pure play lending. Sometimes we may even invest in NCDs of those. So while we have an overall cap, but in terms of how much impact there can be on different players, one on the other, I think that's something we need to understand, that risk.
So one thing which I heard, sorry, Sachin,
last quick point.
Last question. See, what I have seen is the banks are comfortable with 10 to 12% of the total exposure, which I hear when we go to other banks. So anyway, people are talking of 10 to 12 banks, because if somebody's max is 12, then there will be somebody at 7, 8.
Fine, 10 to 12 is fine. We are saying 40, 50.
No, and I agree. I've seen a lot of NBFCs with 30, 40, 50 numbers. I think SBI chairman or FDI MD sir is saying that if I'm taking a call, if I've taken a call for 100 crore, it could be good enough for 400 also. And if I'm willing to give 400, why do I not get it?
I totally agree.
Yeah. I think
Okay.
many NBFCs will be connected to this call. So in that sense, Ashwini ji, maybe you will have
So
some.
this is why we should catch up sometime. I definitely like to
No,
take some time
let's
and
keep
have a
in touch.
discussion.
Please
Yeah,
get
thank you.
Vineet back. We have seen, if I look at last few years, there has been a trend that increasingly, and Ashwini ji also mentioned that increasingly more and more large size PSU banks also being open to lend to overall infrastructure and specifically on solar, which was earlier not so much seen. A few only mid-sized banks or NBFCs were lending. Now we are seeing large banks also lending. The question that I have is, so while on the debt side, the situation is improving, but are you seeing some downturn on the equity interest? Because, with some of the large renewable energy companies, initially all the equity was funded from, global investors. Do you see that as a concern? Because if you see global companies, the ones which are listed also globally, the valuations are low. Even otherwise, it's not really so much of a flavor internationally, even though people talk about it of ESG and all that. So are you seeing a downturn on equity interest in the renewable energy companies, specifically maybe solar?
Sachin, I've been in this business almost since inception. I've set up India's first 15 megawatt projects to the world's largest project during the COVID. And I've never seen so much action happening in the solar and wind sector across the world. So, though there are negative articles which Bloomberg usually writes about ESG focused fund, etc., but in terms of the investors' interest, both from the debt side and equity side, I have seen it as the highest. With the support of IRA in US is first time giving a double-digit return on renewable projects, and and if you look at suddenly the capacity, what India is planning to add in the next 6 years, China adds every year. So, so the whole landscape is changing. I think we are looking forward to a world where terawatt of renewable energy capacity would be added every year. I would share our own example. We were going to market, and some of the Indian bankers we talked to, they were quite skeptical that you are trying to raise $1 billion, and that too for energy transition, not for solar and wind. Is there going to be any appetite when green hydrogen as a sector is not even established worldwide? And we saw that there was so much of interest that we could close the round much ahead of our own requirement. And now every month I get a call from a banker saying there is so much of demand for green equity. Why are you not coming into the public market or raising more money? And now if you look at the large players, like today, say for example, Adani's announced 10,000, so they've crossed 10,000 megawatt in the renewable portfolio.
Right.
And there are at least 4 players I know who have more than 10,000 megawatt of PPA, including us. So when all these projects become operational, you are looking at a very large size company, and these projects are generating good cash flow. The challenge in this sector came when people started doing project at single digit IRR,
Yes.
both in the solar and wind. And then SBI chairman actually told it in a public forum that I'm not going to fund renewable energy projects if my DSCR is below 1.2. So banks actually remained very prudent,
Right.
whether it's a national or NBFC. They always encouraged Indian promoters that don't make the same mistake which thermal player made. And
Right.
fortunately, industry has realized that in some time in the process of building capacity, people bidded at projects IRR which were unacceptable. But now we are seeing a trend where reality is catching up. And in current scenario, I am more bullish than ever before, both on the debt and equity side. We just closed a round of debt round below SBI's 1 year MCLR. I don't want to mention the number right now in public forum, but it is significantly below SBI's MCLR. So today there is a healthy competition. You go out for 2,000 crore
Right,
loan,
right. No,
you are
you're right, sir.
actually getting
Yeah, on the debt side, we are seeing that trend also.
and
You're
same thing
very,
is true for equity.
yeah. Oh, got, got it.
Like if we are uh, unsolicited offers have started coming. But actually, first time I'm seeing there is a differentiation in the market. Earlier, anyone who started a company and had got 50 megawatt or 100 megawatt going could raise money. Now, for type 5 companies, the ability to raise money is far more easier than the next 15 companies.
Got it. Got it. I think that makes sense. Ashwini ji, last question from my side, and then we will open it up for the audience. One thing which is when I look at the banks, and we also saw in the presentation that there hardly been any downgrades in the banks over the last 2 or 3 years, 2 years actually. But one thing which is we are seeing is that the deposit rates are continue to be high. The CD ratio also continues to be high. I think SBI is one of the few banks which is comfortably low, but most of the banks have high CD ratios, mostly the private sector banks, and there is a rush that we see for the deposits. Now, if this rush were to continue, because even if one guy is offering 7.5%, 8%, willy-nilly, everyone has to offer that to be able to, really garner funding. So do you see this kind of, because the question is, even if say RBI were to reduce the rates by 25 bips or whatever, which we are also saying and everyone is saying, but do you think that will really bring down the cost of deposit? Because that, to my mind, will have a significant impact on your names and overall business model, etc. So your thoughts on that?
Yeah, so deposits has been a challenge for the last several quarters. Actually, for last 6 or 7 quarters, the absolute growth in deposits has been lower than the absolute growth in credit.
Correct.
So normally we would argue that deposit has a larger base, so even a lower percentage could be better than loan growth. But last 6, 7 quarters, actually, the absolute number has also been lower. And add to that for the fact that for every 100 rupees of deposit which is raised, we have to set aside 20 rupees for the SLR, CRR, etc.
Yes.
So therefore, actually, the difference between the loan growth, incremental loan growth, incremental deposit growth is even higher. Even if it were to be 110 to 100, let's say loan versus deposit, the gap is much higher. So this has been building up. And that's the result. You see the rate hikes in deposits has actually happened more in the last 2 quarters rather than the previous 4 quarters, because there was a cushion available earlier and now that cushion is depleting. We are very comfortably placed because we have a lot of excess SLR as well, etc. So we are okay, and our CD ratio, as you rightly said, is also relatively lower. So that is one side. Now, why is this happening? Is it only because the rate of deposit? But rate of deposit, in my sense, is a derivative of the demand from the bank side, and the customers today have a lot of other options. One option is, of course, everybody knows about this share market, which has been doing well, so a lot of money going there. Mutual fund, the overall AUM has gone up to 55 trillion and more. So the growth has been really, really strong there. So that money has been going to both these areas. Also, the small saving schemes for a long time were higher than the banks. Now, this wasn't pinching us so much because there was a lot of liquidity. Now, with the liquidity reducing, this is going there. Plus, a lot of people have actually shifted from CASA to or saving bank to TDRs, which has been a major trend. On the institutional side, most institutions are now very careful with cash management, etc., and they want an overnight either a liquid fund or a government institution. Don't invest there, but they invest in a TDR. And in the government side, central government and state government, which is where we are impacted as public sector, they have gone into this just-in-time funding, which is the entire CNA, SNA space, and therefore a lot of that money which used to lie in saving or current accounts across the chain, right from central government to state to districts, has kind of dried up. So a combination of all these factors has led to a reduction in the pool of deposits which used to be available. So therefore, there is a challenge. But my sense is that as Indian story continues, the surplus Indians save continues, and the rates are really attractive now. They are now more than the inflation. They are positive for after a long time. I think this will the deposits go to come back, and as the market corrects, it will again flood back to us.
Yeah.
So market cannot stay high for very long.
Yeah.
Someday it has to correct, and it will revert back. That's my sense.
So many of the issues that you mentioned are actually structural, so that may not really move quarter to quarter. But one point, which we are also noticing, and our presentation mentioned that, is the foreign inflow of debt capital. Generally we only get FPI inflows into equity, but in the last some period, I don't remember exactly, but a significant amount of money has come in. So that, I think, can also ease up the pressure, because that will in some ways vacate the space. Maybe it's coming in G-Secs, but then your need to invest in G-Secs can go down, and therefore that can also ease up your headrooms.
Yeah, I don't think RBI is going to allow that we should invest in SLR. That currently, I don't think it's the case. But anyway, we'll see.
Yeah. Great. So we will kind of now take questions from the audience. Let me just this thing. Can you please make an announcement, Divya?
Sure, sir. Dear participants, we will now begin with our Q&A session. You are requested to key in the queries in your panel. Thank you.
So I have this question for Mr. Vineet Mittal. How do you see the ease of doing business issues playing out in the renewable energy business? Are issues such as getting land, right of way, grid connectivity getting more smooth with time? Are governments at various levels, center, state, and local, more supportive? And overall, is the regulatory system equally supportive?
So, the ease of doing business in India's renewable energy sector has seen significant improvement, especially with the central government efforts to address industry concern through regular meeting and collaborative platform. For example, MNRE as a ministry every month meets developers, manufacturers, and listens to all their issues and takes either action immediately, or where they cannot take action and interdepartmental coordination is required, then they actually do the follow-up and try to solve it before the next monthly meeting. In addition to that, the topmost office does a review quarterly and tries to address the problem. If you look at from overall perspective, after India has adopted one nation, one grid, one frequency policy, you can plug in power anywhere and take out power anywhere. So that has increased ability of developers to choose the states which are developer friendly. Like there are states where there is a deemed conversion of land, where the solar and wind sector does not require any conversion, and all those haggling, etc. And also they have easier leasing out policy and lot of the waivers around the compliances. You are seeing lot more investments are going into those states. I would not say every state has the same experience.
Right.
There are states where there is no ease of doing business, but then there are equally great states where you have lesser challenge on ROW, lesser challenge on land acquisition, and as well as the compliances requirements are lesser. But what
Yeah.
is needed, like they have done one nation, one grid, one frequency. They should do one nation, one grid, one policy, one approval process. So that will make it like a truly ease of doing business. Then you don't have to have 20 states expert understanding every state's policy, that what will work where. And we are advocating it with central government. I think, and we are also advocating that like GST Council has been a great concept where state and center are on board. Power being a concurrent topic, make it a power council where the decisions are taken jointly by the state power minister and national leadership. So then there is no execution problem. Otherwise, sometimes center announces an amazing policy and some state in southern India would say that I won't implement it. And second
Got it.
thing, what is needed is actually the implementation of Electricity Act. Like there is a concept of regional aptels, which has not been done since last like decades. And if that is also implemented, your decision making and dispute resolution will be so fast that this would become the best sector to be in.
Yeah. Great. So we have now a bunch of questions. The next question I can ask is to Mr. Tewari. Two questions actually, I'm combining them. Basically, this is about the private sector. So let me just phrase it. So it says, what is it that has been holding back the private sector from broad-based capex recovery? And when can we expect the private capex cycle to pick up in a meaningful way? This is from Rajni Sinha and Shripad Ote.
So we are
While
already.
you did mention as a response to my first question, but I think the nuanced question is it the private sector which is borrowing, or is it still the government sponsored projects and the infra, NHAI and all that, which is kind of driving the projects and therefore not so much in private sector?
No, I would say that. See, of course, the roads initial demand or initial bid out has to be done by the government only, but it's all the private sector which is executing. So that, and on the power side also, I mean, one can argue that it's driven by the government, but the government can only say that these are the PPAs or etc. available, and who would want to build it up. It's all private sector. So my sense is that we are seeing a lot of private sector activity. There's another thing which I would want to point out, which is a good thing for us overall, which is that a lot of our EPC companies, the bigger ones especially, and these are now specializing in different areas. They are not only constructing their usual roads, bridges, etc. Many of them are into the industrial
Right.
construction, etc. So they are now active in a big way in the Gulf. This entire Neom city, which has been built in Saudi Arabia,
Yeah.
plus also some work in Qatar and some work in UAE. So a lot of our good companies have got very, very big orders there. So I think that's a very good thing. And these generally used to go to either Western companies, European companies, or also Chinese companies. So if we are able to replace Chinese companies in a very large orders, I think that's a massive, massive thing. So this is also what we are seeing, and we are funding some of that. And this is a great risk diversification in my view as well, vis-a-vis India. Of course, metros and other things which are state-driven continue to be strong, but these
Right.
are all planned out. These are not done only to push up the industrial growth. It's like a continuous infra upgrade which is happening. So in that sense, I think it's both private plus public. More private sector demand, yes, that looks at the overall growth in the economy. If suppose the government is interested in, I mean, construction activity is picking up, then all the cement, steel, and everybody else will also.
Right. So, do you see that post-elections, generally there is a view that during election time, that generally people go slow on any large projects, etc. And we've been in this, everyone knew election will happen in early this year. So, are you expecting a major uptick to happen post that, say, maybe second quarter onwards?
Let me put it this way. One, that we are not seeing any slowdown in whatever decision making, in whatever sanction, disbursement, they're all happening.
Right.
For each contract by the government obviously have been stopped for the moment for the next 2-3 months. And after that, I'm sure, because as you are aware, the Prime Minister is on record having said 2 days back at the RBI 90 years conference that a lot of action will be seen. Every ministry is putting together a 100-day plan. So there are a lot of action already happening behind the scenes. So I do think that there will be a lot of announcement, a lot of intent which will come into play very, very quickly as soon as the new government comes in. And we will see the action, which will take some more time, but surely it will happen.
Great. I'm sorry, running short of time. I will ask the last question. That is a question for everyone. It's pretty much a guess, I would say. The question is, how many rate cuts are expected from RBI in FY 2025, considering there are 3 which are expected from US Fed? So, maybe we can start with Tewari ji, aapse, and then we will move on.
See, normally I never speculate. I mean, on every monetary policy, I'm asked this question by the anchor. And I never ever commit, because one shouldn't second guess RBI. Our house view, which is the economist in house, is that at best 1 rate cut, not before Q3. That's
And
our.
for the full year, because that's what people are betting. Abhi to nahi hoga, lekin for the full year, they could be 2 or 3 or whatever,
अभी तो calendar year की बात करते हैं, तो Q3 of this calendar year, which means September.
Q3 is what you're saying. At least
1 rate cut. That's the house view.
Got it. Maninder?
First, somebody who has said that, let them prove that the US will cut the rate 3 times. Fed will cut it 3 times. That itself is now.
I agree. They are in a much difficult situation than we are. So
they have to start, and I think we will only follow, and we'll follow with a lag.
Okay. That's also
Tewari, that it will happen later, but only first they do, and then we'll see what the impact is.
Got it. So it's conditional is how you're saying. Okay, Vineet, your thought?
We are seeing the challenge of bank in mobilizing the deposit. So even if RBI cuts, How much will be passed on to the industry will be a good question.
That's a very, very, very
We are
valid
grappling
point.
with
That
this
has been my
answer.
thought also. It may not just simply translate to end user, getting cheaper home loans and cheaper, solar project loans. So that is a different story altogether, which Ashwini ji explained very well. What are the issues that are facing there. So
No,
great. Yeah.
loan
Yes,
side,
sir.
no, the loan side, the pass-through will happen very quickly in a large number of cases because there are many externally linked loans now, T-bill linked loans, etc. Those will get
Those will kind of come down. Yeah.
there will be an advantage to industry. Our NIMs will contract, that's for sure.
Yeah, and
Yes.
there is enough competition coming from other sectors, other lenders also, as you said, the alternate funds which are available in the market. They are also pushing the rates down on the other side.
Correct. Great. So thanks a lot, Ashwini ji, Maninder ji, and Vineet ji. It was a pleasure to host you, and it was a very, very insightful conversation that we had. I am personally learning a lot of new things from today's discussion. I'm sure our audience would have also, felt the same. And I would have a one-on-one personal meeting with you, I'm sure, over the next few months. Divya, can you please take it on from here?
Thank you
Thank you
for
so much.
hosting us, Sachin.
Thank you.
Thank you,
Yeah.
Sachin.
Thank you so much, Mr. Sachin, for moderating the session, and Smita for your presentation. Thank you once again to all our guest speakers for the insightful views. It was indeed a privilege to host you. And lastly, thank you to all the participants for taking the time out and being part of this CareEdge webinar. For any further queries, feedback, or suggestion, please write to us in the feedback email. Goodbye for now, and I request the tech team to kindly log off.
Thank you.